What is a bubble, right?
Okay.
A bubble is that there's a lot of creation of wealth.
When headlines celebrate record highs and capital floods into a single theme, risk doesn't disappear. It simply hides inside rising prices. If major AI stocks corrected sharply, the S&P 500 could fall close to 20%. That would erase roughly $8 trillion in market value. $8 trillion. About the size of Germany's entire annual economy. That isn't a sector rotation. It's a systemic repricing of wealth. When wealth is repriced at that scale, confidence shifts. Spending behavior changes. Investment decisions tighten. The question isn't whether volatility exists. It's how far it can travel. AI stocks aren't just participating in the rally. They are driving it. Capital concentrates in a handful of companies, and their performance increasingly determines how the broader index behaves. Markets appear diversified on the surface. Structurally, they are becoming narrower. Today, the top 7 technology companies account for nearly 30% of the S&P 500. That means 1/3 of index movement depends on a small cluster of names. When gains are concentrated, risk becomes concentrated too. As prices rise, capital flows in. As capital flows in, prices rise further. This feedback loop reinforces optimism, expands valuations, and strengthens conviction, until momentum becomes dependency. The issue isn't whether artificial intelligence has long-term potential. The issue is whether current prices already assume a flawless future. Perfect execution, sustained growth, and minimal disruption. Extreme expectations reduce margin for error. Assume major AI leaders fall 40%. With roughly 30% index weight, that alone pulls the S&P down about 12%. That's not fear. That's structure. It's the mechanical consequence of index concentration. But markets rarely stop at theoretical numbers. As losses accelerate, stop-loss orders trigger. Leveraged accounts receive margin calls. Forced selling begins. And price declines start feeding on themselves. ETFs rebalance automatically. Index funds reduce exposure. Quantitative models cut risk as volatility rises. Liquidity thins. Bid-ask spreads widen. When buyers step back and sellers accelerate, prices can move faster than underlying fundamentals justify. Structure amplifies stress. History shows that concentrated markets rarely correct in smooth lines. They cascade downward, stage temporary rebounds, and then decline again. Each rally invites fresh selling from investors seeking liquidity. What begins as valuation adjustment evolves into momentum reversal. When structural fragility meets leverage, volatility expands quickly, and containment becomes difficult.
So I talk about that kind of complacency. I'm talking about the asset price in the United States, and it's a long list of things. It's QE, it's fiscal deficits, it's global fiscal deficits, it's potential of the trade wars, it's these huge complex geopolitical situation, and I look at all of those probably not being properly priced into the marketplace. But we don't know what's going to happen.
When indexes fall double digits, retirement accounts shrink. Employee equity compensation declines. Household balance sheets contract. The wealth effect reverses. When people feel poorer, they spend more cautiously. Psychology shifts before income statements do. Discretionary consumption slows. High-end purchases decline. Housing transactions weaken. Corporate revenue expectations adjust. Lower expected growth feeds back into valuation models, reinforcing downside pressure in equity markets. Falling stock prices raise capital costs. Lower valuations restrict equity financing. Expansion plans pause. Hiring slows. In some cases, layoffs follow. What began as financial volatility begins influencing real economic decisions. At that stage, the correction is no longer isolated. It becomes embedded in corporate strategy and consumer behavior. High valuations depend on low discount rates. When interest rates rise, future cash flows are worth less today. Valuation models adjust downward automatically. Even without earnings deterioration, price-to-earnings multiples compress. If growth expectations soften while rates remain elevated, markets face dual pressure. Earnings forecasts decline and discount rates stay high. That combination can produce price declines larger than the underlying slowdown itself. High-growth sectors are especially sensitive to this dynamic. When these three forces align, markets lose resilience. Not because innovation fails, but because pricing moves too far ahead of reality. The margin for error narrows, and volatility becomes the mechanism through which balance is restored. Artificial intelligence may transform entire industries. Companies may succeed. But investment cycles rarely move in straight lines. Bubbles minimize risk on the way up and magnify it on the way down. If the market falls 20%, how concentrated is your portfolio? How exposed are you to a single narrative? How much volatility can you truly tolerate without being forced to react? The real question isn't whether a bubble bursts. It's whether you are positioned to remain rational if it does. Thank you for watching. I appreciate you taking the time to think through this with me.